Greetings. My name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today's Friday, January 6, 2023. So happy New Year to everybody. This is our monthly market monologue, and we're going to start by talking about 2022, kind of a year in review, so to speak. We'll talk a little bit about how bad was it, how difficult of an environment was 2022. We'll certainly talk a little bit about 2023 and what we can expect, and we will also begin talking about the Secure Act 2.0 that was recently signed into law. And then we're going to talk about some important client updates at the end. So make sure if you're a client, you watch all the way to the end. That said, we do want to encourage you, if you haven't already, please click that subscribe button on YouTube. And we would love it if you would leave us some comments, whether you're watching this on the Facebook platform or LinkedIn or on YouTube. We would love if you would leave us a comment. Feel free to ask any questions. And as always, we will list our contact information if you want to follow up with us, have any specific questions. We would be more than happy to see if we can help. We do have the two offices, one here in Cary, North Carolina, one in Southern Pines, North Carolina. And naturally, in today's digital world, we do work with clients all over the country. So that said, let's dive in. On the screen now is the S&P 500 for last year, January 3rd. This is the first day of the trading year, and then we end the year over here. So you can see that we are in a downtrend all year long. There was a couple of what we call bear market rallies. There was a bear market rally here in March. There was another bear market rally in July. And then from the October low, a bit of a bear market rally as well. And again, we're going to come back to this chart in just a minute. So obviously, 2022 was a very difficult year. But the question, of course, is how difficult was it? To keep things in perspective, we have been showing this chart pretty much all year long. And the bold red line represents 2022. All of the other lines represent a different year for the S&P 500 since I've been alive. I was born in 1976. And so what we can say is that 2022 was the third worst year since 1976. So that's true for the United States of America, but how difficult was it for the rest of the world? So on the screen now is a list of ETFs that I call my single country ETFs. Every country is not represented on this list, and there are some regions on the list. They're not all single country, so single country is in quotes. But what we're trying to show is how difficult the environment was for the entire world. The bold black line in the middle of the screen represents the zero line. And what we want to show here is that there's only two of these single country ETFs that are above the zero line, Turkey and Chile. And we'll talk about those specifically in just a minute. If we take those two countries off of the chart, every other country, single country ETF was negative for the year, some less so than others. And you can see the significant volatility in some of these single country ETFs. So 2022 was a very difficult year all around the world. While that is certainly true, when we look at this relative comparison chart of single country ETFs, we do see two of them, Turkey and Chile, that had positive returns for 2022. So let's take a brief look at them now. So we'll start by taking a look at the single country ETF that represents Chile. On the screen right now is 2 years worth of history. But before we talk about that specifically, I want to talk about this black line, which represents the 200-day moving average. Generally speaking, we want to be holding things that are in an uptrend. We don't want to hold things that are in a downtrend. The 200-day moving average generally represents or generally tells us whether or not a security is in an uptrend or a downtrend. So if a security is trading below the 200-day moving average, it is widely considered to be in a downtrend. If it's above the 200-day average, it's considered to be in an uptrend. So when we look at the Chilean ETF, we see a high of April of 2021. It corrected and found its way below this black line. So it's now considered to be in a downtrend because it's below the 200-day moving average. It spent the rest of the year below the 200-day line. So the majority of 2021, the Chilean ETF was in a downtrend. Then we're going to fast forward and zoom in a little bit. So now all we've done is zoomed in, and so we see January 3, 2022 is right here. Notice we are still below this black line. We are still below on this Chilean ETF. It is below the 200-day moving average. Now, you can look at the end of the year and see December 30th, the final trading day of the year, the Chilean ETF was barely above the 200-day moving average. So when we look at that relative comparison chart and we see that the Chilean ETF got a 17% rate of return, it's a little deceptive, because effectively what had to happen with this ETF is it had to get a 17% rate of return just to get back above the 200-day moving average. So would we have wanted to own this? Well, we also look at that volatility. There's an awful lot of volatility in this particular ETF. Do we really want to own that? Do we really want to ride through volatility like this, not knowing how it's going to end up? And the answer is no. So now let's talk about the Turkey single country ETF, and that's represented on the screen. Again, we have 2 years worth of history. Again, calling your attention to the black line, which represents the 200-day moving average. I also want to call attention to this very large gap down in about March of 2021. That is one of the biggest things to take away from this chart. Yes, when we look at January 1 or January 3, 2022 to the end of the year, Turkey had this massive run of 99%. But one of the things that we have to look at as investors when we're investing money for other people is we have to look at the risk. And there is a lot of geopolitical risk with Turkey in particular. And in particular, we look at things like these gaps. And so, yes, had a massive run. But when we look at this, we see that when we had a bear market rally here in the United States in March, we see that the Turkey ETF also had a rally, and you can see that didn't last very long and it fell right back down. And again, in July in the United States, we had a bear market rally, and Turkey had that same thing too. But again, here we're looking at this point and saying, well, last time it got to this point, it fell right back down. So this level is suspect. Well, it gapped through that, and gaps like that can be encouraging and exciting if you already own it, but if you're looking as an investor to buy into something, that is also can be very dangerous. And so you see, again, it gapped up and then it fell apart again. And then we see these series of gaps and runs and gaps and runs, and at any time we're very cognizant of the geopolitical risk and the history that this particular ETF can gap down against us very quickly. So yes, it's encouraging if you happen to own this and you are up 99% for 2022. But as investors of other people's money, we also have to look at the risks, and there's a lot of risks in this chart. So returning to the United States, this is fixed income. And again, highlighting just how difficult 2022 was. Look at this. This is negative 33%. Long-term treasury bonds, negative 33% on the year. And all of these fixed income securities are negative for the year. So 2022, again, just an all-round bad year. So 2022 was also a midterm election year. We've been talking about that a lot. And we earlier said that 2022 was the third worst year since I've been alive. Well, it turns out that it was the third worst midterm election year since the S&P 500 was created. You see, 1974 was pretty bad. 2002, obviously, we know that was bad. And then last year, 2022. And then we've also talked a lot about the year after a midterm election year. So this is the year after the midterm election year, and we've discussed the fact that historically, the year after a midterm election year can be very good. In particular, we said 1974 was a really bad year. Well, look at 1975. We also said 2002 was a really bad midterm year. Well, look at 2003. So those are encouraging data points. But what can we conclude from that? Absolutely nothing. We also have to look at there are years like 2015. 2015 was a year after a midterm election year. That was negative. You see 2011, that's not missing data. That was just a pathetically flat year. And then 1987. So just because last year was very negative, it doesn't mean that we can say, hey, 2023 is going to be a very positive year, at least not in the stock market parlance. You just can't draw that conclusion. Now, we also talk about the fact that December, we typically get what we call a Santa Claus rally. By his seasonality standards, December is generally a pretty good month. On the average, we get about a 1.5% rate of return on the S&P 500. Well, what was December 2022? It was -6. So again, very appropriate for 2022 to have such a negative December because the overall year was just bad. So on the screen now is the S&P 500. This is for all of 2022. And I just want to highlight one thing really quickly. It's this level of 3,800 on the S&P 500. And you can see when we had this rally off of the October low, we came into the 200-day that obviously didn't hold. Many thought the 3,900 level on the S&P would hold it. It rallied off that. It again fell through it. So we've been hanging out a little bit below this red line, which is the 50-day moving average. We've been holding out at this 3,800 level for quite some time. And obviously the concern that we have is whether or not we're going to fall through that level or we continue to rally off. A very important level to see what's happening. As I'm recording this, the S&P, it does look like it's having a pretty good day today. It's still within this range, though. It's bouncing back and forth between these two levels. And so that's going to be important for us to continue to watch and dictate how aggressive we want to be. Now, we talked a minute ago about the midterm election years and how challenging midterm election years can be, and how historically the year after a midterm election historically is fairly decent. And the averages ends up being like 15 to 16%, something like that on the S&P 500. However, I don't want to be Debbie Downer here, but I do need to remind you that there is precedence for the stock market in the United States to have back-to-back losses. We see, of course, many of you probably remember 2000, 2001, and 2002. That's 3 years of back-to-back-to-back losses. We really hadn't seen that since 1929, 30, and 31, if memory serves me correctly. But again, just looking at modern history, we do see, is this look like 1973 and 1974, 2 years of back-to-back losses. We could also look at, I think this is 1969, and then you say like 1970 technically wasn't negative, but that sure isn't very positive either. So again, a very negative years, there's a lot of reason that we want to be optimistic about the coming year. There is some historical precedent for having a positive year after such a negative year, but you can't just aggressively say, you know what, we're going to be aggressive now because it's a new year and the year after a negative year is positive, because that's not always true. And one of the reasons why we would be concerned that it's not going to be true this year is simply because of the economic environment that we find ourselves in. So on the screen right now is the Conference Board's U.S. Economic Outlook, and you can see they're estimating that fourth quarter GDP is going to come in at positive 0.7, but look at their estimates for 2023, negative, negative, negative. So unfortunately, history suggests that the stock market does not bottom before a recession starts. And so far, the National Bureau of Economic Research has indicated that the first and second quarter of 2022 is not a recession, even though we see 2 consecutive quarters of negative GDP. So the question then becomes is, well, if we're not in a recession, how confident can we be that the stock market has already bottomed if the recession hasn't even started? And there's a strong argument to be made that if we see a recession in 2023, it will be the most forecasted recession in U.S. history One more economic data point that we'll talk about today, then I will discuss briefly the changes to the required minimum distribution laws, and then provide an update on some improvements that we're making within the firm for all of our clients. So on the screen is one of the yield curves that we pay attention to, and we look at this one in particular based upon Dr. Campbell Harvey's research, who wrote his 1986 thesis on this. And his thesis basically says that when this yield curve inverts, in other words, when it goes negative, when it goes below that black line, the zero line, when it goes negative, it forecasts a recession. Well, if we zoom in to see where we're at right now, we are definitely below that zero line. And according to Dr. Campbell Harvey's research, that suggests a recession is coming, which is in line with a lot of the other forecasts that we read and some of the pundits that we listen to. Now, Dr. Campbell Harvey himself, however, is suggesting that it might be flashing a false signal. He goes on in this LinkedIn post to discuss some interesting data points that are definitely true, and I see his points that he's making. So I'm still concerned that 2023 we will see a recession. I'm still very much aware of the fact that historically the stock market does not bottom before a recession starts. And as for me and my team, when we're investing money for our clients, we're not going to worry about what any particular pundit says. We're going to worry about what the price action is telling us. And that's how we are making decisions in our client portfolios. So finally for today is an update on required minimum distribution rules as a result of the law that was just passed. So that information is on the screen. If you have any questions, feel free to reach out to your advisor. We'll be happy to explain in more detail. That said, I want to also give our clients a heads up that we are beginning to roll out an upgraded client portal. And so we will be discussing that more in depth in the coming days, weeks, etc. So stay tuned in that regard. I'm very excited about the capabilities of this new portal. So far it looks good. We're still testing it a little bit before we really begin widespread rollout. But we are definitely trying to get that done before the tax season so that clients can have a better experience of getting all of their tax documents, et cetera, et cetera. So anyway, that's enough for today. Next week, we'll go into a little bit more depth on some of the economic data that we're looking at for the year ahead. And if you have any questions, by all means, feel free to reach out to me and my team. We do have the two offices, one in Cary, one in Southern Pines. And again, we work with clients all over the country. So until next time, thanks for watching and have a good weekend.